Good afternoon and welcome to Bulls, Bears, and the Bell. Thank you for joining us. We are taking a deep dive today, and our focus is really fixed squarely on one of the most, well, volatile and, frankly, perplexing trading sessions we've seen in a while. Thursday, October 23, 2025.
Oh, absolutely. It was, without question, an extraordinary session. It delivered this enormous cognitive dissonance, really. It kicked off reflecting, well, profound pessimism based on, micro-level corporate failures. Things weren't looking good, yet it completely reversed course, turned on a dime, and finished the day strongly positive. It was quite something.
That's exactly it. That's the core conflict we really have to unpack today.
Mm-hmm.
Our mission basically is to analyze all the sources you've pulled together, the corporate reports, those geopolitical cables, the market flow data, just to understand precisely how disappointing earnings, especially from, massive tech names, were just utterly overwhelmed by a single abrupt geopolitical event.
And what's fascinating here, I think, is how quickly the market narrative pivots when it's faced with a true external shock like that. This wasn't just some gradual shift in sentiment. It was fundamental, an instantaneous change in the dominant focus, moving immediately from company balance sheets, that micro story we started with, straight to global macro risk and, importantly, inflation.
And the trigger wasn't even economic data, was it?
No, not at all. The catalyst was purely U.S. foreign policy, specifically the White House announcing new sanctions. It's just a remarkable demonstration, really, of the profound immediate impact Washington can have on domestic equities, literally changing the direction of the S&P 500 mid-morning. It forces investors, instantly to reevaluate every single position based on this big picture macro risk rather than how well a company actually performed last quarter.
Okay, let's unpack the mood leading into the open then.
Yeah.
Because as you said, it was, well, toxic seems like the right word. Pre-market pessimism was palpable. We had huge names missing expectations the night before, really souring the sentiment right out of the gate.
Yeah, the initial pressure points were absolutely dominated by the fallout from tech giants like Tesla and IBM. Those reports were not good.
And that corporate anxiety, that was almost the easy part of the negative story, wasn't it?
It really was. Because it was immediately compounded by these severe, entrenched macro concerns that were already weighing really heavily on investor psychology. I mean, you had the U.S. government shutdown already grinding into its fourth week.
Right, which means no key economic data.
Exactly. The government wasn't releasing vital economic data, think jobless claims, things like that. And this data vacuum, it creates enormous uncertainty for economic planners, for the Federal Reserve. They're forced to rely on incomplete, sometimes just anecdotal information. It's not ideal.
And on top of that domestic political mess, you had international friction bubbling up again. We saw reports resurfacing about potential U.S.-China trade friction, specifically this idea of placing new restrictions on software exports.
And that single contemplation adds immediate jitters, particularly to the technology supply chain. It's a very sensitive area.
So let's recap the start of the day. Bad tech earnings, this macro data blindness from the shutdown, and renewed trade uncertainty. That's a potent triple threat.
Absolutely. And the market duly reflected it with a lower open. Indices were under pressure, reflecting cautious risk-off sentiment. The key question, really, the first part of the morning, was whether we were going to test recent lows. Things looked pretty grim.
But then, as you noted, around mid-morning, the entire trajectory just shifted. Dramatically, violently even.
That's right. The news hit U.S. sanctions against major Russian oil producers. And that acted like a shockwave through the market. It instantly canceled out pretty much all the previous negative sentiment that had been building.
A shockwave that immediately triggered a sharp, almost explosive rally in crude oil prices.
Exactly. And that was the powerful, immediate tailwind needed for the entire energy sector.
Which is heavily weighted in the major indices, of course.
Precisely. So that energy rally lifted the broader market, reversed all those early losses, and actually provided enough momentum to keep the indices climbing steadily right through the afternoon. It was almost impervious to the continuing bad news filtering through from some of those tech names.
And the final tally really confirms the power of that reversal.
Yeah.
Let's look at the numbers. The S&P 500 closed up 0.56%. The NASDAQ composite, and this is despite all that specific tech gloom we talked about, actually managed to rise 0.86%.
Yeah, pretty remarkable given the early pressure. And the Dow Jones Industrial Average advanced 0.25%. So, a solid, decisive, positive day across the board.
Especially considering where it started just 4 hours earlier. It looked almost certain to be deep in the red. But I want to focus on a nuance here in the index performance. What stands out to you that really validates the power of this sentiment shift, beyond just the headline numbers?
Well, I think the crucial detail, if you dig a little deeper, is the performance of the Russell 2000. That's the small cap index. It gained over 1%. That's a strong move.
Okay, and why is that significant?
Because small caps are generally seen as more of a barometer for domestic economic strength. They're usually less exposed to the specific earnings disappointments of those, mega cap tech giants that were weighing on the NASDAQ. The fact that the Russell 2000 not only survived the morning sell-off, but actually finished with the strongest relative gain, well, it indicates something important. It suggests that the positive, powerful, risk-on mood, the one established by that oil surge, it broadened out across the market. It wasn't just contained to energy.
So it overcame those specific tech headwinds.
Exactly. It overcame those specific sector-related headwinds and signaled that fundamentally risk appetite was back on the menu for reasons far outside corporate balance sheets.
Yeah.
This wasn't some narrow, technically driven rally. It was a systemic macro risk reevaluation playing out in real time.
Okay, so let's drill down into that core catalyst then. The sanctions. It wasn't just vague sanctions, as you said. This was highly targeted U.S. action against Russia's largest oil producers, Rosneft and Lukoil. For the listener, maybe explain why targeting these two names specifically caused such a market panic over supply.
Right. Well, when you target Rosneft and Lukoil, you're not just targeting any companies. You are targeting the absolute giants of Russian oil production and, crucially, their export capacity. These are massive players on the global stage. Now, while Russia certainly has mechanisms to try and, divert sales to non-Western buyers, think China or India, the immediate effect of these kinds of sanctions is to inject massive uncertainty into the global energy trading ecosystem. Traders immediately fear two things. First, that a significant portion of the global crude supply suddenly becomes legally constrained or perhaps financially complex to insure and transport. That gums up the works.
Okay.
And second, there's the potential for secondary sanctions, meaning penalties on firms, maybe banks or shippers that continue to deal with Rosneft and Lukoil. That really chills activity.
So it sounds like an instant, almost manufactured supply shock, and the market reaction was, well, explosive.
Precisely. West Texas Intermediate Crude Oil Futures WTI, they just soared, up by more than 5%. They settled at over $61 per barrel, which marked a 2-week high.
Wow, 5% is a huge move for oil in one day.
It really is. And you have to understand, moves of that magnitude aren't usually driven by, say, weekly inventory reports or subtle shifts in demand forecasts. They're driven by pure, acute geopolitical anxiety regarding supply availability. Simple as that. When oil moves 5% in a single session because of a political announcement, the entire market has to sit up and pay attention.
And that explosion instantly translated into an unparalleled boom in the energy complex, right?
Oh, absolutely. The Energy Select Sector, SPDR, the XLE ETF, was the undisputed MVP of the session. It gained 1.3%.
And were there specific names leading that charge?
Yeah, we saw some specific high flyers really leading the way. Valero Energy, VLO, which is a massive refinery name, climbed more than 7%. Huge gain. And APA Corp, that's an exploration and production company, it rose over 6%.
So the whole sector was lifted.
The dominance was pervasive. I mean, even the integrated industry giants like ExxonMobil and Chevron, they posted solid gains too. And because they're so big, they contributed massive positive weight to the S&P 500's close. To put it really simply, if the energy sector had not had this geopolitical tailwind, the major indices would almost certainly have finished sharply down. They would have been dictated by those corporate earnings failures we talked about earlier.
Okay, this raises that interesting question, though, the sort of perverse rally dynamic we touched on. Geopolitical risk usually spurs a flight to safety, right? We saw gold rise nearly 2%, hitting its own multi-month high. That makes sense. But these specific sanctions created an immediate inflationary impulse via oil. So why is the market prioritizing the immediate cash flow boost to Exxon today over the certainty of higher transportation and labor costs for basically every other company tomorrow? It feels counterintuitive.
It does, and that is the absolute core of the paradox here. Look, high oil prices are immediately fantastic for energy companies, no question. They boost their short-term profits. They allow them to improve their quarterly forecasts. It's simple math for them. And this immediate fundamental boost in such a massive, heavily weighted sector lifts the S&P 500 overall. Mechanically, it has to.
And then technical factors kick in.
Right. Traders who were perhaps shorting the market, betting on those weak earnings, they're suddenly forced to cover their positions quickly as energy rips higher. That covering action amplifies the upward move, so it becomes a short-term, almost self-fulfilling prophecy based purely on that sector outperformance.
But at the same time, the prospect of higher sustained energy costs
Yeah.
that fuels broader inflation concerns throughout the entire economy. I mean, particularly for consumers facing higher prices at the gas pump and for any company that relies heavily on transport, which is a lot of companies.
Exactly. And this is where the connection to the bond market becomes absolutely essential. Bond traders aren't thinking about Exxon's next quarterly report. They're thinking about inflation persistence. They anticipate that if inflation is persistent, and look, a 5% spike in oil pretty much guarantees some persistence, then the Federal Reserve will be forced to maintain or maybe even accelerate its hawkish stance to try and curb those price pressures.
And that's why yields moved up.
That's precisely why we saw the yield on the benchmark 10-year Treasury note climb right past that key psychological 4.00% level.
Hitting 4.00% is significant, isn't it? Can you elaborate maybe on the meaning of that level for listeners?
Yeah, it really is significant. Crossing 4.00% on the 10-year yield is a major psychological and technical hurdle. For fixed income traders, it signals a meaningful repricing of risk and, crucially, inflation expectations. It implies that investors are now demanding a 4% return just to hold the quote-unquote risk-free asset for 10 years. That reflects pretty deep skepticism that inflation is going to quickly return to the Fed's 2% target.
And the practical impact.
More practically, it immediately puts upward pressure on borrowing costs right across the economy. Think mortgages, corporate debt, consumer loans, everything gets more expensive. So while energy stocks are cheering this oil spike, every rate-sensitive sector, and frankly every borrower, is getting squeezed. That's what establishes this profoundly fragile rally dynamic. It's built on a contradiction.
That stark contrast between sectors really is the story of October 23rd, isn't it?
Yeah.
While energy was experiencing this geopolitical boom, technology and industrials were just stuck in the doldrums.
Absolutely. The technology select sector SPDR, the XLK, and the industrials SPDR XLI, they were the day's biggest laggards, down 1.0% and 1.3% respectively.
That is a massive divergence from the broader market index, which, as we said, was pulled up mainly by energy.
It is, and that divergence throws the market's internal health into really razor-sharp relief. You see the underlying tensions. The weakness in tech specifically stemmed from a pretty clear confluence of negative factors. The primary drag was definitely the lingering fallout from those disappointing earnings reports from sector bellwethers. Tesla, IBM, Netflix had reported earlier. These are huge names. When those massive, highly visible companies stumble, the whole technology sector just feels this gravitational pull of lowered expectations for future growth. It casts a shadow.
And adding to those earnings woes were the renewed U.S.-China trade tensions we mentioned, specifically regarding potential new restrictions on software exports. Any hint of trade restriction in that incredibly complex web of tech supply chains seems to create immediate jitters. What kind of software are we actually talking about here, and why does this threat cause such immediate pain?
Well, we're primarily talking about things like advanced industrial software, specialized design tools, maybe complex enterprise management systems, things that often have what are called dual-use applications.
Meaning commercial and military.
Exactly. They could potentially serve both commercial and military purposes. So restricting these exports creates immediate uncertainty, not just for companies that rely on the enormous Chinese market for revenue, but also for firms whose global operations depend on the standardized, unrestricted flow of these essential digital tools. It disrupts operations. Essentially, it signals a potential acceleration of this technological decoupling trend we've been hearing about. And that raises fears that supply chains might have to be fundamentally reorganized, which is always costly and very time-consuming.
And that uncertainty would hit the semiconductor industry particularly hard, wouldn't it? They're right at the core of these global tech supply chains.
Absolutely. The semiconductor industry is arguably the most sensitive to these kinds of trade and geopolitical skirmishes. They live and breathe global supply chains. And we saw a really stark example of this. ST Microelectronics, or STM, they're a key player in the European chip space, but have significant exposure to global markets. Their stock plummeted more than 14% after their earnings release.
Wow, down 14%.
Yeah, a massive single stock move like that clearly illustrates the sector's acute vulnerability to these global supply and trade disruption fears. It shows that even with a broader macro tailwind coming from the oil price surge, the specific headwinds facing globalized technology companies were severe enough to cause major sector-specific damage. Their pain was very real, even if the overall NASDAQ index numbers were slightly flattered or lifted by the sheer weight of that broader market reversal driven by energy.
Okay, let's pivot back then to the micro-level stories. The company earnings that were supposed to dominate the day before the sanctions news hit. While Tesla and IBM grabbed all the negative headlines, the earnings docket actually wasn't uniformly grim, was it? There were some truly strong pre-market positives that maybe helped counterbalance some of that tech gloom. We should probably look for thematic contrasts here. Why did some companies seem to thrive while others faltered so badly?
That's exactly the right analytical lens to use here. The results from the industrial sector, for instance, actually suggested some underlying economic resilience that seemed completely distinct from that consumer-driven tech malaise or the specific issues at IBM. Take the industrial giant Honeywell, HON. They delivered a really strong Q3 beat, both on earnings $2.82 CPS versus the $2.56 consensus and on revenue. Good numbers. But critically, Honeywell also raised its full-year guidance.
Oh, the guidance is key.
Always. Raising guidance suggests confidence, right? Confidence in long-term capital spending trends, maybe infrastructure projects picking up, defense spending remaining robust. That positive outlook sent Honeywell shares up by more than 6%, a solid reaction.
Okay, so we see industrial strength and capital goods there. What about the consumer and service side? American Airlines also offered some surprisingly good news pre-market. They reported a much smaller than expected Q3 loss, negative 17 cents per share, which easily beat the consensus estimate for a loss of 27 cents.
Right. And like Honeywell, they too raised their Q4 guidance. They projected a full-year profit,
Which lifted their stock over 5%. But hang on. American Airlines raising guidance when we've got this government shutdown potentially choking off consumer travel sentiment, that seems a bit counterintuitive. Is the market really believing that forecast, or could that just be short covering given how beaten down airline stocks have been?
Well, it's probably a bit of both, to be honest, but mostly I think it reflects that underlying travel demand, once it was released post-pandemic, is proving incredibly durable. It seems to be overcoming these temporary political headwinds like the shutdown. Airlines benefited from pretty disciplined capacity management and strong pricing power through the summer, even if maybe business travel lagged a bit. The Q4 guidance implies they expect the underlying consumer resilience to continue, shutdown notwithstanding. So for now, the market seems to be giving them the benefit of the doubt, perhaps believing the shutdown is a temporary headwind, not a fundamental structural failure for travel demand.
Okay. We also saw T-Mobile, the wireless carrier, outperform expectations. Both top and bottom lines beat EPS of $2.59 versus a $2.42 estimate. Solid numbers. Yet their stock actually fell more than 3%. What happened there?
Yeah, the market is complicated sometimes, isn't it? That negative reaction. Well, it may have been due to a specific accounting item, perhaps an impairment expense mentioned in the report that spooked some investors. Or it could simply be investors deciding to take profits off the table. T-Mobile had run up significantly heading into the earnings release, so some profit-taking wouldn't be unusual even after a beat.
Right. And you mentioned some other pockets of strength.
Yeah, don't forget some of the underlying commodity-related names. Union Pacific, the railroad, posted narrow beats. And Freeport-McMoRan, the big mining company, reported strong results. Freeport was aided significantly by high gold and copper prices, which is actually a great example of how these macro tailwinds, like high commodity prices, can directly benefit specific corporate balance sheets, feeding back into the micro story.
But the real corporate drama, the stuff everyone was waiting for, really shifted to the after-hours session, specifically with Intel, INTC. Intel was a huge focus stock, wasn't it? Especially after that remarkable 84% year-to-date rally they'd had.
Absolutely. That rally was fueled largely by optimism around government funding the CGPS and strategic partnerships they announced, all designed to help them recapture market share they'd lost. Expectations were immense heading into their Q3 report.
And the Q3 numbers themselves.
They did deliver a phenomenal Q3 beat. I mean, non-GAAP EPS was $0.23. That absolutely crushed the Wall Street consensus estimate of just 0 to 1 cents. A huge beat. Revenue also came in strong at $13.7 billion, also ahead of expectations. So exceptional performance for the quarter itself. It indicates their cost-cutting measures and maybe some initial progress in their foundry business are starting to pay off.
Okay, that sounds like a roaring success story then. But you said drama. So here's where it gets complicated, right? This complicates the Intel recovery narrative.
Exactly. The problem wasn't Q3. Q3 was great. The problem was the forward look. Intel's guidance for the fourth quarter was viewed by the market as distinctly weak, and the technical details here really matter.
Okay, break it down for us.
So Intel forecasts Q4 revenue in a range of $12.8 billion to $13.8 billion, and crucially, a non-GAAP EPS of just $0.08. And here's the key point. This guidance excluded the results from their recently spun-off Altera unit.
Altera, that's their programmable solutions group.
That's right, FPGAs and the like. By excluding it, they're giving a much clearer, maybe starker picture of the health of their core businesses, primarily the data center and PC chip segments.
So why does excluding Altera, which sounds like maybe a cleanup or a positive step for clarity, lead to weak sentiment? Wouldn't that be good?
You'd think so, but it's about what's left. Because without Altera's contribution, the projected sequential decline in revenue, and particularly the collapse in EPS down to just a zero at 8 cents, well, it signals profound weakness, or at least a significant slowdown, in their primary segments. Client computing and data center AI, it looks like they might be tapping the brakes quite hard going into year-end. And this tepid outlook completely undercuts the positive momentum from that fantastic Q3 beat.
So it's like a psychological trap for investors.
Almost perfectly so, yeah. You have phenomenal past performance in Q3 that seems to validate the last 6 months of share price gains. But then the Q4 outlook makes it sound like the growth story is slowing or maybe delaying significantly. That weak outlook is going to seriously test whether that 84% recovery story can actually sustain itself against what looks like potential structural weakness, or at least a pause in their core markets. The market reaction after hours reflected that uncertainty.
Okay, moving on from Intel. You also flagged Ford, reporting after the close. The automaker was expected to report against a pretty tough backdrop, right? Analysts were anticipating an EPS decline, consensus around 38 cents.
Yeah, Ford is definitely battling some significant headwinds right now. They themselves have cited high tariff-related costs as one issue, and then there are the ongoing substantial losses in their electric vehicle division, the Model E unit. The transition to EVs is proving immensely costly and complex, not just for Ford, but really for every traditional automaker trying to make those new divisions profitable. It's a huge investment phase.
However, Ford did have a powerful counterbalance that might appeal to investors, didn't they? Strength in their legacy business.
That's right. Their traditional internal combustion engine business, particularly trucks, remains highly profitable. They reported a strong Q3 U.S. sales increase of 8.2%, and that was driven primarily by their F-Series trucks, which are cash cows for them.
They also mentioned record electrified vehicle sales.
They did, which includes hybrids, not just pure EVs. So the actual report was really poised to be a major test, a test of consumer resilience and that strong truck demand versus these industrial margin pressures and the heavy costs of EV investment. A real balancing act for them.
And the action didn't just stop at the closing bell, did it? The extended hour session had its own drama.
Nope.
It gave us glimpses of where momentum was maybe building and where the pain was continuing from the regular session. We saw some really interesting, quite specific moves driven by government-related news, particularly in the quantum computing space, which is usually highly speculative.
Yeah, government interest, or even just rumors of it, is often the biggest and most sudden catalyst you can get in these kinds of high-growth, potentially disruptive tech areas. Shares over Getty Computing, RGTI, and IO&Q, they both surged around 8 or 9% in after-hours trading.
And what was the news there?
It was based on reports unconfirmed at the time, but reports nonetheless that the Trump administration was considering taking actual equity stakes in these quantum computing companies. Now, if true, that isn't just a symbolic vote of confidence. It potentially fast-tracks funding, maybe secures long-term government partnerships, and it could suddenly transform their perceived commercial viability overnight, hence the pop in the stocks.
Okay, interesting. On the downside, though, the weakness we saw during the day for some of those tech titans, it persisted into after-hours trading, didn't it?
It did. IBM continued its slide, losing another 6.4% after the close, really adding to its daytime losses, and Tesla dropped another 3.81%.
When you see that kind of follow-through selling after hours, what does that usually signal?
It typically signals that investors are truly worried about the forward guidance or maybe the underlying reasons for the miss, not just the headline Q3 numbers themselves. It suggests deeper concerns are settling in.
But we also saw some really extreme movers, individual stocks related to their own specific corporate news. These often get missed when everyone's focused on the macro narrative.
Absolutely. Molina Healthcare, MOH, that's a managed care organization, was a notable decliner. It plunged nearly 20% in after-hours trading, a huge drop.
20%. And another one.
And Integer Holdings, ITGR, a medical device manufacturer, dropped over 31%, just cratered.
Wow. Losses of that magnitude,
Yeah.
what typically causes that?
Yeah, these massive after-hours losses usually signal a drastic market reaction to extremely disappointing earnings or, more likely, disastrous forward guidance. Something that suggests a fundamental negative shift in their business outlook, maybe severe margin compression, something far worse than just a slight earnings miss. The market is basically saying the story has changed dramatically for the worse.
Now, while all this corporate drama and geopolitical news was flying around, the macroeconomic context was highly unusual, wasn't it? Because of that government shutdown, now dragging into its fourth week, this shutdown has essentially obscured key data releases, like the weekly jobless claims report suspended for 4 consecutive weeks now. It feels like we're flying an airplane without an altimeter.
That's a good analogy. We really are operating with an incomplete picture of the economy's actual health right now. And that obviously heightens the importance of any little piece of data that does manage to get released.
And that opacity must be dangerous, especially when the Fed is trying to figure out what to do with interest rates.
It is dangerous. They're forced to rely more heavily on, anecdotal evidence from company earnings calls, like we heard from Honeywell and these regional Fed surveys. It's not ideal for making policy, yet we did get a few snapshots that suggested maybe some underlying resilience despite the shutdown chaos. Existing home sales, for instance, came in at a 4.06 million annualized pace.
How did that compare to expectations?
It was basically right in line with the 4.1 million consensus forecast. So it suggests some stability, albeit at a low volume level in the housing market, even with those high mortgage rates biting.
Okay, stability there. But you mentioned a regional survey had a surprise.
Yeah, the real upside surprise came from the Kansas Fed Manufacturing Index. The overall composite index for October rose to 6, which beat the consensus expectation. But the really interesting part was the manufacturing component within that index. It jumped sharply to 15, up from just 4 the previous month.
That sounds like a powerful regional data point. How much weight can we actually put on something like that, though?
Well, you're right to be cautious. It is only a regional survey covering just that specific Federal Reserve district. However, that sharp jump in the manufacturing component to 15 is pretty significant for that region. It suggests potentially improving industrial activity there, maybe driven by specific factors like defense spending or agriculture-related manufacturing, and it definitely goes against the broader narrative of a national industrial slowdown.
But can it overcome the national anxiety?
Probably not. In the context of a national government shutdown, this single regional bright spot, while welcome, can't possibly overcome the national anxiety caused by the complete lack of visibility on the national labor market health or overall retail sales. It offers maybe a sliver of hope, but certainly not clarity.
Okay, so if we try and connect all these threads back to the bigger picture, the cross-asset currents seem to confirm that inflation fear was really the dominant reaction to that geopolitical shock from the sanctions. We already noted the 10-year Treasury yield climbing right up to touch that exact 4.00% level. That reflects mounting inflation anticipation in the bond market.
Absolutely. And the commodities complex reflected those dual concerns perfectly. Inflation risk and geopolitical risk intertwined. WTI crude oil, as we've discussed, was the epicenter of the move, soaring 5.4% on the day. Huge move. But gold futures also experienced a strong bid. They rose nearly 2% to close around $4,135 per ounce.
And that gold move is the classic safe haven response.
Exactly. That demand for gold demonstrates investor desire for hard assets amidst global uncertainty and perhaps fears of currency depreciation down the line. Standard flight to safety. Interestingly, the U.S. dollar index also ticked slightly higher on the day. It probably benefited from some safe haven flows as well, perhaps as investors pulled capital from riskier emerging markets in response to the heightened geopolitical tension.
Okay, what about the crypto world? It often marches to its own beat. Did it react or did it sit this one out?
Well, it showed signs of caution, actually. Bitcoin itself traded relatively steadily, holding around the $110,400 mark. Didn't collapse, but didn't rally either.
And what was the sentiment described by the analytics firms looking at blockchain data?
Glassnode, which is a well-known blockchain analytics firm, described the overall sentiment in the crypto market as being hedged in fear. So despite the relative stability in Bitcoin's price, the underlying trading patterns apparently suggested high caution among participants.
Still feeling the effects of that earlier liquidation.
Seems likely. Traders are probably still processing that massive $20 billion liquidation event that happened earlier in the month. That really tempered the bullish enthusiasm that had characterized the start of October, as some were calling it. The fear of further large-scale institutional liquidations means that while crypto didn't collapse on the geopolitical news, It certainly wasn't participating in the risk-on aspect of the market rally that was being driven primarily by the energy sector. It was cautious.
Right. And you mentioned Ethereum showed relative weakness.
Yeah, Ethereum, ETH slipped a bit, trading near $3,829. That was down about 6% week over week, so showing some underperformance compared to Bitcoin. Overall, the digital asset market remained pretty measured. It looked like traders were trimming risk exposure ahead of that critical U.S. inflation data on Friday. They understand that if the Fed has to get more aggressive with rate hikes because of a high CPI print, rate-sensitive assets like crypto often tend to suffer disproportionately. So caution was the watchword there.
Okay, so despite Thursday's wild, geopolitically fueled rally, it feels like the market's near-term trajectory is now overwhelmingly dependent on just one single economic release. Friday's September Consumer Price Index, the CPI report.
Absolutely.
With the government shutdown limiting the availability of pretty much all other key economic data, this inflation reading has taken on critical, almost outsized importance, hasn't it? It's like the last major data point before the Federal Reserve's upcoming policy meeting.
The stakes really couldn't be higher, particularly because we have this fresh inflationary impulse coming from that 5% oil spike we just witnessed on Thursday. That's going to feed into future inflation numbers. Consensus forecasts were already anticipating that headline inflation probably accelerated for a second straight month in September. That means the energy component was likely already driving up costs, even before these new sanctions fully manifest in prices.
And perhaps more critically for the Federal Reserve's long-term policy goal is core inflation, right? What's the expectation there?
Core inflation, which strips out volatile food and energy, was expected to remain steady but still elevated, around 3.1% year over year, and that is still stubbornly well above the Fed's official 2% target. It suggests that inflation pressures might be broadening out, becoming more embedded beyond just energy and food prices. That's what really worries the Fed.
So let's play out the scenarios. If we get a hotter than expected CPI print on Friday, say core inflation comes in at maybe 3.3% or even higher, and that's compounded by the known effect of the oil spike,
Yeah.
what happens then?
Well, that would seriously challenge the market's conviction in this narrative of a dovish Fed. The idea that the Fed might soon be able to pivot and start cutting rates. That kind of hot number could trigger a really rapid repricing of interest rate expectations. It could push the 10-year yield well clear of 4.00%, maybe towards 4.1% or higher quite quickly. And that would likely ignite significant volatility across all asset classes, almost certainly hitting rate-sensitive tech and high-growth stocks the hardest. It could undo Thursday's rally very fast.
Okay, conversely, what's the best case scenario for the market heading into Friday's print? What are the bulls hoping for?
An inline number, or even better, a softer than expected inflation reading, would be seen as a huge relief, like a green light for the Fed to maybe hold pat for now and proceed cautiously with whatever rate cut schedule the market has been pricing in. That outcome would likely validate the recent market advances, including Thursday's unlikely macro rally, and potentially fuel further gains. It could possibly even push the S&P 500 towards testing new yearly highs.
And the market's positioning reflects this suspense.
Completely. The fact that stock futures were trading basically near the flat line in the evening session on October 23rd tells you everything you need to know. The market is just holding its breath, extreme suspense, anticipating this single pivotal data release that will ultimately determine which narrative takes control. The macro risk narrative, driven by energy and inflation fears, or the hopes for a more sustained economic recovery and a friendlier Fed. Friday's number is everything right now.
While this was certainly a truly unique day to dissect, October 23rd, we saw a perfect and really powerful example of how sudden macro, specifically geopolitical risk, can just completely overwhelm very specific corporate micro risks. The market started the day worrying about Tesla's profit margins and IBM's outlook and ended it rallying almost solely on the premise of Russian oil sanctions. And crucially, as you pointed out, the day's positive close for the major indices was entirely dependent on the energy sector's massive surge. It really covered up underlying weakness elsewhere, particularly in tech and industrials.
It absolutely did. And that leads us directly to the final, perhaps fundamental question that you, the listener, should really be mulling over as you look ahead to the consequences of this kind of reversal. We established pretty clearly that the U.S. market rallied strongly on Thursday due to geopolitical risks, the sanctions that simultaneously drive inflation. We saw it immediately in spiking oil prices and the 10-year yield crossing 4%. So, question is, What happens to this positive market momentum when the immediate benefit to energy company profits is fully priced into those stocks? And the negative macroeconomic consequences, things like reduced consumer spending because of higher gas prices, increased freight costs hitting margins everywhere, maybe broader inflation forcing the Fed's hand when those negative effects begin to fully manifest across the rest of the economy. This suggests that the positive close of October 23rd, while feeling good in the moment, could in fact be the very beginning of a deep exploration into this concept of a geopolitical trap rally, where the very thing that rescues the market in the short term, the energy spike, is also the potential seed of its eventual undoing down the road. Something to think about.